Frequently asked questions. How do you handle situations that might involve both a 1031 exchange and also Section 121 dealing with the primary residence rules? In this segment, what we want to do is kind of cover what each IRC, I'm not saying that well, back to it. Frequently asked questions. The God, frequently asked questions. Internal Revenue Code Section 1031 and Internal Revenue Code Section 121. There are oftentimes many questions the taxpayers will ask about converting a rental to a residence, converting a residence to a rental, maybe a property that's what we call a split treatment transaction that consists of both a residence and rental property, or a residence and property used in a farm or a ranch. So in this segment, we're going to go ahead and look at two tax code sections and how taxpayers might be able to utilize both in different circumstances, and maybe later on convert a property from one type of property to another. So we're going to go through some different scenarios. IRC Section 1031 deals with tax deferral on the sale of any property used in a trade or business or held for investment when exchanged for like-kind replacement property to also be used in a trade or business or held for investment. So under Section 1031, this provides taxpayers with tax deferral. The basis of the relinquished property is carried over into the basis of the replacement property. Contrast that with IRC Section 121. Now, this is tax exclusion on the sale of a principal residence held for 2 out of 5 years. So taxpayers that meet these requirements can exclude up to $250,000 of gain if filing single, or they can exclude up to $500,000 of gain if filing married and jointly. Section 121 provides tax exclusion up to these threshold amounts. So Section 1031, tax deferral until a property is sold for cash. Section 121, the primary residence or principal residence tax rules, tax exclusion up to these threshold amounts. So let's look at some different scenarios. First, you as a taxpayer can do a 1031 tax deferred exchange on property held in a business use or held for investment. Second, you can take advantage of Section 121 under the principal residence rules when somebody lives in a property. Third, you can take advantage of what's called a split treatment transaction. This would be part Section 1031, held for investment or used in a business, and part Section 121, a principal residence that somebody lives in. Fourth scenario, converting a rental property into a residence. So this would be converting a property that was part of a 1031 exchange and converting it over into Section 121 property treated as a principal residence. And finally, scenario number 5, this would be converting a residence into a rental property. So it's a scenario where a taxpayer has lived in a property as a residence, they move out, and they then convert this into a rental property that can qualify for a 1031 exchange. So we're going to go through in this segment these different scenarios and briefly address these. The primary residence rules, and you'll see a summary of them here on this next slide. This is when a taxpayer lives in a property. Again, it provides tax exclusion, and it must be a principal residence for at least 2 out of 5 years. And when you look at it, it's really going to be at least 24 months out of a 60-month period. The time period does not need to be concurrent. They don't need to be successive months, but we'll be looking at an aggregate over a 60-month time period. Are there 24 months where the taxpayer treated their property as a principal residence? Again, the exclusion for single filers is up to $250,000 of gain. It's for married couples filing jointly up to $500,000 in gain, and the exclusion is available every 2 years. And please note that second homes and vacation homes don't qualify for Section 121 tax exclusion. So that's a summary of these rules. As a taxpayer, It's vitally important that you review your specific situation, your unique facts and circumstances with your tax and legal advisors to have them properly assess what approach works best for you. But let's walk through some of these scenarios. In a split treatment transaction, this is where a property is used partially as a principal residence, partially either held for investment or used in a business. In this scenario, the taxpayer would want to get together with their tax advisor and then allocate a portion of the gain to the principal residence, which is Section 121, and then allocate the other portion to the investment or business portion, which would be for qualify for tax deferral under Section 1031. When the property is sold, the allocation associated with the principal residence, the taxpayer can receive that money from the sale because that is treated under Section 121. It doesn't require it to be held by a qualified intermediary. They receive those proceeds, and Section 121 tax exclusion applies up to the threshold amounts that we've already discussed. Secondly, taxpayer can then have a qualified intermediary step into their shoes as a seller of the portion of the property held for investment or used in a business. So the intermediary would then be assigned in through an assignment of the contract, and the intermediary would then receive the proceeds from the portion of the property that is being held for investment or used for a business. Now let's look at this, and again, there are a number of ways this can happen. On the next slide, you'll see a very simplistic example that helps illustrate this. Taxpayer owns a fourplex, so it's a 4-unit property. 3 of the units are rental, 1 unit they live in. Now let's assume this taxpayer lived there for at least 2 out of 5 years. Under this scenario, the portion that is their principal residence qualifies under the Section 121 rules as a principal residence, and they can exclude taxes up to the $250,000 threshold if single, or up to $500,000 threshold if married, filing jointly. They receive that portion of the proceeds. The proceeds from the sale of the 3 rental units, they would work with a qualified intermediary, and prior to closing, contact the qualified intermediary to have them step into their shoes. The qualified intermediary receives the proceeds from those 3 units, and then they do a 1031 like-kind exchange into replacement property. So that's a split treatment scenario. I don't have a slide for it, but we do run into this also with taxpayers that own large farms and large ranches. It's not uncommon for someone to have a lot of equity built up in a ranch or farm that they've owned for a long period of time. So it might be a $3 million farm with a relatively modest farmhouse on a corner of it. Let's say a $300,000 farmhouse on a $3 million farm that's been used entirely as a farm. The acreage associated with the farm would then qualify for a 1031 exchange. And again, you'd work with your tax advisor to determine that. One benchmark that can be used, and sometimes is the amount of land associated with the farmhouse would go down to the minimum subdivision size. So let's say it's in a rural area and properties can be subdivided down to 5-acre parcels. So 5 acres of the land value and the $300,000 house would be considered principal residence. The remaining almost $2.7 million of that $3 million sale could be held in could go through a 1031 exchange. Again, I don't want to complicate this too much. In a farm or ranch, there might be personal property that's involved, tractors, farm equipment, other things, irrigation equipment. So again, another reason why it's important that the taxpayer's tax advisor is involved from the onset to help look at those allocations and make sure that things are structured properly. But I just want to let you know this applies to more than just a fourplex or a duplex or an apartment building. It can apply to farms and ranches and other types of real property that are owned. Let's go to the next scenario. Converting a rental property into a residence. So this would be going from Section 1031 into Section 121. First off, and this is vitally important, the property that's acquired in an exchange, the taxpayer must have an intent at that time to hold the property for investment purposes. And in a perfect world, that taxpayer should have robust facts and circumstances and documentation that supports at the time of the exchange their intent was to hold the property for investment purposes. Now let's say that down the road years down the road, the taxpayer's intent changes with that property. That is permitted. So, a couple things to be aware of in this scenario. Number one, if somebody does a 1031 exchange into a property that is later converted, their intent changes down the road from rental usage to wanting to be a principal residence, there is a minimum 5-year holding period after the exchange is over. Now, to be eligible for the Section 121 tax exclusion, the taxpayer must use the principal residence for at least 2 out of 5 years. So they have to meet the rules under Section 121. And what happens is there's an exclusion under 121 looking at a ratio of the time of how much the property was used as a principal residence compared to how much of the time it was used for rental or business purposes. Keep in mind depreciation, recapture that was taken during the time it was used in a business or held for investment is not allowed to be excluded. So let me try and give you a real life example to walk through this. A taxpayer performs a 1031 exchange into a replacement property that they rent for 3 years. 3 years after the exchange is over, the taxpayer intent changes, and they decide they want to move into the former rental property, and they live there for 5 more years as a residence. So the total ownership period is 8 years, 3 years under Section 1031 as a rental, 5 years under Section 121 as a principal residence. The taxpayer is eligible for a ratio of the amount of time that they lived in it as a principal residence versus a rental property. So if you look at this, for 5 years they lived in as a residence, so they're eligible for 5/8 of the 121 tax exclusion because that's the amount of time that they lived in it. So certainly, if we take another scenario, let's say somebody rents it for 3 years and they live in it for 10, so 13 years. Well, then they get a ratio of 10/13. So obviously, the longer they live in as a residence, the closer they're able to get to getting a higher ratio of Section 121 exclusion. And then again, the depreciation recapture is not eligible for tax exclusion. I want to go ahead and finish up one more planning opportunity in this segment, which is converting a residence into a rental property. So this would be converting 121 property into Section 1031 property. And fortunately, we have guidance on this particular issue. Revenue Procedure 2005-14 provided guidance on when a taxpayer lived in a property and then they converted it into a rental. So first off, as in any Section 121 tax exclusion, the taxpayer must meet the requirements of Section 121. So it must have been their principal residence for 2 out of the past 5 years. Then the taxpayer, they lived in it, they move out of the property and they convert it to a rental. And this comes up quite a bit. There are people that move, people in the military, people in other jobs where they might have go through principal residences fairly quickly. And it's not uncommon for someone to maybe convert a residence into a rental. And it could be done because of financial needs. It could also be done because the market is soft and they want to go ahead and convert it to a rental and wait for the market to come back. So the taxpayer moves out of their principal residence and now is a rental property. And let's just say it's been rented for a couple of years. So if they rent it for 2 years, they've lived in it for 3 out of the past 5 years, they're now eligible for both tax code provisions. So they get the benefit of the Section 121 tax exclusion up to the 250,000 threshold if single, up to 500,000 threshold if married, filing jointly, and they then can do a 1031 exchange because now it's a rental property and their intent has been to hold it for investment purposes. So yeah, I'll give a simplistic example. Let's say it's $1 million residence with $1 million in gain and it's a married couple filing jointly. They can exclude $500,000. The remaining 500,000, because now it's a rental property, on the sale, they work with a qualified intermediary who receives those proceeds. They then exchange that $500,000 property for another $500,000 replacement property. So you're able to have one transaction but take advantage of both Section 121 tax exclusion and Section 1031 tax deferral on one transaction. So this could be an excellent planning strategy for taxpayers that are in areas where property values have appreciated a lot. This happens a lot on both coasts, but in many other parts of the country. This can be a fantastic planning opportunity to take advantage of both Section 121 tax exclusion and the potential for Section 1031 tax deferral into another like-kind investment or business property. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.